Today we are honored to welcome, I'd say our favorite technical analyst, but I think at this point it's America's favorite technical analyst, Katie Stockton. How are you today, Katie?
I'm great. Thank you for that, Al.
Absolutely. Thank you.
I mean, I got into this in 1997 and had been doing technical analysis already for a couple of years during college for Dorsey Wright and Associates. So I've been at it for a long enough time to see the industry evolve quite a bit, where it wasn't as widely accepted when I got into it. I had to, in a meeting with a client or prospect, I would have to explain not only my market views, but also the discipline, right? You'd have to go in there and explain where these views were coming from, and often it's somewhat defensively, because it just really wasn't that mainstream. Now it's quite different. I think there's a very general knowledge out there of technical analysis and its benefits. So I no longer feel like I have to defend the discipline except in rare cases now. And people seem to have a better understanding of its place in sort of the broader investing process or analysis, which also consists of fundamental research and macro inputs, political inputs. It's all of that taken together along with technical analysis that you can get your powerful biases and takeaways. So I would contextualize sentiment data within a broader context as one of the market's internal measures. It would also include breadth. We've all heard of breadth or market participation. Leadership, that's often either new highs and new lows on an exchange, or sector leadership, perhaps. So breadth, sentiment, leadership, and then I'd add also volume as these market internal measures. So they're the things that basically aren't price that can inform a market bias. However, we always give the most weight to price. So I would classify the indicators that we use in three ways. We talked a little bit about relative strength, so that would be one category or classification. Overbought, oversold metrics are really important to us. And then, of course, momentum. So it's those three classifications that sort of house the indicators that we use. But I don't think actually, there's any like right answer as to what indicators folks do gravitate towards, because I think they all have information and they're all derived from price, right? So, if somebody likes an RSI better than a stochastic oscillator just because they're comfortable with it, that's great. So we tend to use the MACD indicator or moving average convergence divergence indicator. We like the cloud model, which is also called Ichimoku. We like to use moving averages. Those are all trend following metrics. We like to use the stochastic oscillator and the DeMark indicators, as you saw on our charts earlier. So it's all of that, though, taken together where you kind of shape a view. So I've always been a believer that technical analysis is so good for anything that has like a very pure supply-demand relationship. And that would really apply to FX, right? Sort of a 24-hour market, deep global liquidity. You don't often get massive price swings intraday. These days, I feel like more more than way back when, but even still. And then commodities. Commodities also have that deep global liquidity. And you've heard of CTAs. I mean, the commodities are often traded by technically minded traders. So to me, that those are two great asset classes in terms of technical analysis. And we spend a lot of time there, but we spend more time on equities. So equities, you would suspect, are a little bit disadvantaged in that regard, right? The supply-demand relationship is a little bit muddier, where, clouded by fundamentals, clouded by politics, often, places without great liquidity, fees that are embedded in exchange traded products, things of that nature kind of muddy the waters of equities, and yet it still is highly applicable, right? So maybe the support and resistance levels that you're looking at for the price charts aren't quite as precise, as they might be for a commodity or for FX. But still really very applicable. And we only really shy away from applying are indicators on something that's highly illiquid, right? So, or something maybe that's highly like binary, like it's something like a security tied to an FDA approval, something of that nature.